On this episode of Investment Insights, we break down the 8 major themes investors need to consider as we start 2025. To download a complimentary copy of these 8 themes, please visit opalinvest.com. Thanks for tuning in to this episode. My name is Jay Coulter. Joining me, as always, Austin Graff and Adam Mueller. In this special episode, we're going to break down the 8 major market themes that we think investors need to pay attention to in 2025. Guys, our first theme is the S&P 493. Where are the opportunities beyond the largest players in the market? Austin, let's start with you.
Yeah, there were a lot of themes kind of outside of the Magnificent Seven, which most people have been focused on for the last 2 years. One of them being AI. Mag 7 has been a huge beneficiary of AI capital so far. However, they're not necessarily the ones seeing the earnings growth from AI. We think it makes sense to look at some of the names that are benefiting from that earnings growth. It's just one of the themes that we think makes sense as some of the growth in the market rotates from kind of the 7 largest companies to other sectors. We think that investors should be looking at those other sectors as they can be owned at significantly better valuations.
Yeah, there are definitely a lot of other themes around this and a lot of other ideas. Adam, what are your thoughts?
Look, my thoughts are that I think, as Austin alluded to, the Magnificent Seven may have played itself out a little bit. We've been focused on that for a long time, and we may see the market, we may see more market breadth in 2025. And you might want to pay attention to the other companies, the other 493 companies in the S&P 500 versus the Magnificent Seven. Now, there's also a chance that the Magnificent Seven or that several stocks continue to drive the market, but it's different names. See, what have we seen in the past couple of weeks? We've seen a lot of headlines talking about how maybe Broadcom is the next NVIDIA. I don't necessarily think it's going to have the same kind of run that NVIDIA has already had, but that just speaks to the idea of people looking around for what are the winners going to be over the next few years, rather than just sticking with what's worked over the last couple of years.
Yeah, and when you think probabilistically, you think about something like NVIDIA has a $3.3 trillion market cap. That's a pretty big number. For you to see another double out of NVIDIA, it's got to be $3.3 trillion, a lot of money. If you were to see a 10% increase in NVIDIA, you'd essentially be creating another Fortune 20 company from that market cap increase. It just doesn't seem to be a high probability event that these massive companies can continue to grow at this pace indefinitely.
You know, another theme inside of this theme of opportunities outside of the Mag 7 is around energy. Energy's had a little bit of a tough run the last 2 years, but there's opportunities in renewables and grid infrastructure. Adam, what are your thoughts around the energy space as we head into 2025?
Energy, it's a fascinating space, and it's tricky, right? Because there's a question of what's demand for energy. And if you split that into 2 different types of demand, one just being the sort of traditional energy demand. We're running our air conditioners, we're running our lights. Companies need electricity to run their operations. And then the second is AI energy, the energy required to run these chips and these servers that do all the work in the background for all these AI processes. And when you put it all together, it feels like over the next 3 to 5 years, there's a huge lack of energy in the U.S. And that's going to need to be filled by all means of energy, from renewables and also from traditional sources. So there's a lot of opportunity in the energy space.
Yeah. What are your thoughts, Austin, on energy as a sub-theme to staying away from the Mag 7?
Yeah, I actually think the energy sector, and historically energy has been more of the carbon-based energy. It's how people have referenced it. I think going forward, energy is going to include more the carbon-based kind of EMPs, but also utilities and some merchant electricity producers, because they're all kind of getting to the same thing, coming up with ways to power the economy going forward. And so as you see some of the Magnificent Seven companies plow tens of billions of dollars into data centers, they need something to power those data centers. And you're seeing some beneficiaries being merchant power companies. You're also seeing transmission companies need to put significant amounts of capital to work, which for them, they actually get a regulated return. So it provides really solid growth. If you look at some of the individual companies, it's really interesting. You have companies talking about the last 10, 20 years, average annual growth has been in the 1% to 3% range. And the next 10 to 15 years, they expect to see growth in the 6 to 12% range, depending on which company you're looking at. So if you're looking at valuations, you have to factor in the point that future growth is expected to be significantly higher than historical growth because of some of these AI issues, because of reshoring, and then factor in what you think that valuation should be for the future given the growth, and not just look backwards and say, over the last 10 years, this thing has been trading at 12 times. So 12 times the reasonable place for it to be.
Well, Austin, I'm sorry, Adam.
Can I just add one thing on AI, because this really seems to have been the focus so far? Just also remember that AI at the sophistication that it's at today is a new technology, and it remains to be seen how companies can use it to their benefit. And we don't need to get into the events of the last 2 weeks. Suffice it to say that the U.S. health insurance industry has been put under a spotlight because of recent events. And what's one of the criticisms? That large U.S. health insurance companies are using AI to adjudicate claims and not using humans. And the result of that is people might suggest that you need that context that a human brain can give to that, rather than just using AI. I only mention that to say that AI is not a panacea for everything. There's going to be fits and starts. People are going to try it. It's going to work. It's not going to work perfectly. It's going to need to be adjusted. So it sort of remains to be seen if all this investment reaps the benefits. And it feels like it will eventually, but in the short term, there's going to be some hiccups.
Yeah, I think with some of these nascent technologies, people often draw that straight line up and to the right, thinking that, things are just going to be perfect from here to whatever the optimal end result is. And whether you're starting a business or you're working with a new technology, that's never the way it works. Right now, it does seem like the equity markets are, factoring in that straight line up and to the right. Maybe you want to call it a hockey stick, whatever. It's likely going to be a more jagged line. And so we think as we see some of those kind of movements in the jaggedness of that line, you could see some adjustments in valuation.
Another sub-trend for this idea of investing outside of the Mag 7 is around some of the trends in healthcare. One of those trends that we've really seen start to manifest are these GLP-1 drugs. Austin, what's the investment opportunity there?
There's a number of different ways to take this one. There are two companies that have kind of dominated the market. The question really is, are they going to continue to dominate the market or not? That's kind of the easy kind of first order question. The second order questions are, how will GLP-1s impact other companies? So how will they impact other pharmaceutical companies if the GLP-1 usage actually brings down more illness rates and make the population healthier? Additionally, you could think about, how will GLP-1s impact? I mean, people are going all the way to fuel costs for airlines because they're going to have fewer fat people on airplanes. Now, I think that's a little bit far, but you can see how this can ripple through the economy, and people are really excited about it. So again, they're acting as though, what is currently a small portion of the population taking GLP-1s is going to turn into a majority of the population. It's likely to be somewhat of a jagged acceptance as, we have different levels of adoption and we figure out what the long-term side effects are. But they are considerations that one should take into when thinking about investing.
And Adam, sticking with the healthcare theme, are there still opportunities in the aging population?
I mean, sure. I think the theme that a population is getting older and is going to need more healthcare over time is one of those slow and steady themes that'll be around for the next few decades, unless there's some drastic changes. The trick was something that sort of, it's a slow grind. So in a short-term perspective, or even a medium-term perspective, it's hard to bank on that as the sole piece of an investment thesis. But it's there and it's in the background, and it is true that people are getting older. As you get older, the vast majority of people's healthcare costs over their lifetime is towards the end. So dealing with that is certainly a theme and an issue not only an investing theme, but an issue that the government's going to have to take on at some point sooner rather than later.
And Austin, another sub theme here is around big pharma and any opportunities or, quite frankly, hurdles they might have as we head into 2025. What are your thoughts?
Yeah, big pharma and healthcare have effectively become highly politicized, whether it be the events of a few weeks ago in New York City, or whether it be the recent election results. Right, like everyone's kind of talking about what can happen as a result of the election, and we're definitely seeing some push pull come out. Whether you look at folks that are expected to be in senior leadership positions within the incoming administration. You've got RFK, who is kind of a wild card, and then you have Dr. Oz, who essentially wants to create more of a nationalized healthcare system, which seem to be in contradiction to some of the policies that were kind of campaigned on. So it's really anyone's guess, and I think that to invest in this environment effectively, you really need to focus on valuations and probabilities, because you don't want to get too far down a rabbit hole on something that you see online, or something, some headline that you see, because we've seen those headlines reverse pretty quickly.
And so, Adam, wrapping up this theme of opportunities outside of the Mag 7 here in the US, where are there opportunities around reshoring or nearshoring inside of that space?
Well, look, I think there are some value opportunities within sort of U.S. based industrial companies that could be very interesting as reshoring takes place. But as Austin mentioned, you got to look at valuation, and you have to look at what the ultimate sort of demand is, and then overlay your view of the economy, which still seems to be doing great or good, but at some point, that's going to turn. So I think I still think that this sort of reshoring idea, as well as all of the potential policies of the incoming administration, is a bit of a wait and see how it plays out. Whether it's what are the impacts of these tariffs going to be? I mean, so far the impact of all of the, I guess, campaign rhetoric has been volatility. And not like the VIX per se, but just volatility around how people are thinking about all kinds of different industries and spaces, and stuff reacted after the election, and now it's come back down because is there going to be deregulation? Is there not? I would say be very careful if you're trying to invest today thematically for something that you think is going to be coming out of the U.S. government. And maybe wait and see what actually happens. Although never a bad idea to be prepared. Just don't pull the trigger until it actually happens, because it might not, or it might not at the magnitude that the market already thinks it will.
Yeah, I would say the market tends to overshoot to the positive and the negative for many of these elements based on headlines that are out there. And if you were to invest, you want to look at opportunities where it's maybe overshot to the negative, picking up some companies on the cheap, where if the actual policy that comes out isn't as negative as maybe the market's forecasting, you can make some money, rather than trying to ride the wave on the upside, because that overshoot can be painful on the way back down.
Well, there's a reason this was our first theme for next year, opportunities outside of the Mag 7. We spent probably the most time on this that we will in this podcast, because there are a lot of opportunities. Active management matters now. You have to pay attention given where the market is set up. Let's move on to our second theme, and we've already touched on it a little bit, and this is AI valuations. As we head into 2025, Austin, what are your thoughts on the AI marketplace?
Yeah, it's interesting. The theme of 2024 seemed to be, if you were plowing tens of billions of dollars into AI data centers, you could do no wrong. And I think in 2025, people should really be thinking about who are the beneficiaries from an earnings and cash flow perspective. So who are the recipients of those tens of billions of dollars? NVIDIA is obviously one of them, but there are others. There are some utilities that are out there. There are some merchant power producers. There are other hardware providers in the data centers, and they have the potential to see explosive growth as these large companies continue to plow money into AI data centers. I think one thing to be cautious of, if a company is putting up 10, 20, or $30 billion a quarter, Is that contributing to growth of the underlying business? If it isn't, you got to start asking the question, is it worth the investment?
Adam, what are your thoughts on this theme for 2025?
Yeah, well, I'd almost look. I don't want to compare what's gone on with companies and AI to the internet bubble of 1999 and 2000. But if you did take something away from that, it's that there were winners and losers, right? There are companies with huge valuations in 1999 that aren't around anymore, and then there are companies that are around and flourishing and doing great. And I think we'll see the same thing with respect to AI over the coming years. There's going to be winners and losers. So don't put your eggs all in one basket. Don't get too crazy. As Austin mentioned, when you look at like the valuation of an NVIDIA, can it double? It's not going to double again just because it's doubled in the past. But perhaps there are other companies that stand to benefit and haven't had that same kind of run up. And that's what everyone's looking for. That's what a lot of people. That's what caused a little bit of a rotation into Broadcom last week. Does this have more room to run than NVIDIA? And I'll bet I'd be willing to bet that a lot of those dollars that went into Broadcom were coming out of NVIDIA. And if you look at the stock price movements over the last week, that it probably bears out as supports that idea. So I would just be careful and try to be as diverse as you can, even within a given theme.
All right, so AI valuations is our number 2 theme for next year to keep an eye on. I bet over the course of this year, this was the number 1 topic that we discussed during the year. I hope it's not the case next year. In fact, I think the number 1 thing we're going to be talking about next year is our third theme, and that is value stocks. They've had a horrendous run for a long period of time, and it's picked up here recently at the end of the year. Austin, what are your thoughts around value stocks as we head into 2025?
Yeah, I think it's, people like to put companies in different categories, whether it be value or growth. And I think Warren Buffett says it best when he says value and growth are tied at the hip. And so what we really need to look for is some lower priced companies that have the ability to grow in 2025 and beyond. I think there are a lot of opportunities with companies that have nice double-digit growth that are still trading at a discount to current market valuations, and even at times a discount to historical average valuations, which I think creates a really unique opportunity that looks like a setup similar to what we saw in 2000, 2001. Now, that being the case, if you're a bull in the market today, you would say, hey, in 2000, 2001, the top of the market wasn't earning any money. I would argue that many of the companies that are investing tens of billions of dollars that are getting the valuation today aren't actually earning any incremental cash flow or money from that investment. So it's a similar dynamic. However, we have to wait and see how things play out.
Adam, what are your thoughts on value stocks as we head into 2025?
Well, I'll tell you this. You can go for breakfast, you can go for lunch, or you can go in the middle and you can go for brunch. I'm a big fan of brunch. When I think of value and I think of growth, I was like, what's in the middle? Like growth, or what we would call GARP, growth at a reasonable price. That seems to me like, look, when something gets too cheap, it doesn't take much for that to revert. But you obviously have to be careful of value traps. We saw a company last week. All they did was reiterate the guidance they'd already given to the street, and the stock was up at 1.4%. Simply because the valuation was so low, and it was a stock that had been left for dead for most of the year. So it got a little pop just by saying, yeah, what we said before, yeah, nothing's changed. And that's sort of the trick with value stocks, with things that are very inexpensive, is that you own them and then you wait. And it can take a long time. There's people that have waited a decade and have, at points over the history of the stock market. So look, I think value matters. I think after a long, when people get valuation sensitive because the growth stocks have run too far, they look to value, and it's companies with strong free cash flow, companies that pay a nice dividend, that return capital to shareholders. And buy back shares, particularly when their valuation is low. And it's a good deal for them to be buying back shares at those valuations, which is a huge caveat. Those can be very interesting ideas, especially after a growth wave.
Historically, when interest rates rose, people look back to value stocks because you're looking at discounting of cash flows, and often value stocks have more cash flow today relative to future cash flows. We're currently in this market where people think if interest rates rise or fall or stay flat, the only thing you need to do is buy growth. And by growth, they indicate it's kind of magnificent seven. It's unclear what's going to break that mentality, but it doesn't necessarily make sense from more of a technical perspective. When I say technical, I mean like a scientific or an academic perspective. It doesn't mean that it's wrong. It just means that we have to do a little bit more work to figure out kind of what's going on underneath the surface.
So, is the idea behind this theme that we think value could have a resurgence next year? Are there particular sectors that we should be paying attention to as investors? Austin, what are your thoughts?
Yeah, I think there are certain sectors that have really solid secular growth and are kind of being ignored because they don't talk about AI on their conference call or on their earnings releases. And so, for example, we know there's a significant housing shortage in the US, and we know there are companies that are delivering far better cash flows than they have in the past with decent growth. They're not seeing the valuation that they should, mainly because people are fearful of interest rates. You have, some of the electricity companies, right? We talked earlier about how energy is kind of shifting from carbon-based energy to electricity, maybe with some renewables. As that takes place and we see better growth amongst these companies, we would expect those valuations to revert back to something above what we've seen over the past 10 plus years. Those are two kind of spaces. I think healthcare could also be an interesting space, but we do have some of the headwinds coming out of the new administration, so you have to be careful there. But the aging population is kind of an overriding secular trend there that will likely play out for the benefit of the companies. We just have to see how some of the kind of wiggles take place along the way as policy changes have a short-term impact on companies. But those are some of the themes that I've been focused on, and I think the team here at Opal has been focused on for the last few weeks.
Our fourth theme for 2025 is this tug of war between inflation and disinflation. Adam, as we roll into 2025, what are your thoughts?
Look, I don't usually quote Jeffrey Gunlock, but I heard him yesterday, and he said something, and it's so simple, and I don't think people understand. So I'm gonna say it. I'll say it slowly so everyone can absorb it. Prices won't go down. Right. We're trying to tame inflation, although it does feel like it's a little bit stuck above where the Fed wants it. But it has come down, but it's not going to go negative. Prices aren't going to come down. We just want to stop them growing at too high a rate. So the strain on the average U.S. consumer of their grocery bill or other things they buy, that's not going to go away. And I think that's something that at some point in 2025 people are going to figure out. And I think going back to our prior theme, I think when the economy starts to slow down, the Fed is stuck in this weird spot where they haven't gotten inflation where they want it, but they can't hit the gas on the economy, but rates are still kind of high. So they're in this weird place. People are going to, at some point in 2025, they're going to have to hide in value stocks.
Interesting. Austin, what's your take?
I think this is a highlight of why the transitory inflation argument is so stupid. And I can't believe that, the Fed and smart people on Wall Street were really kind of pounding the table with this argument a few years ago, because at the end of the day, wages weren't growing by 7, 8, 9% a year. And so now Powell is sitting there in a press conference trying to convince people that even though inflation's in the twos, it's going to take multiple years of wages in excess of the twos for people to get back to where they were in 2020 or 2019. And so it's very obvious for someone that just sits back and thinks about it. But then you have the Fed, whose policies don't necessarily support what is happening there. And so I think you're in this situation where the Fed's trying to talk up markets and kind of talk up liquidity into markets, which are supporting the upper class and the upper middle class in the country, but it's really kind of pushing down. It's creating a significant divergence between the haves and have-nots. It'll be interesting to see how this shakes out. because it does seem like, there's a pretty big, group of people in this country that feel like they're at a disadvantage. And some of that has to do because the Fed policies aren't really all that thoughtful when it comes to how it impacts kind of the blue collar worker.
The idea of the Fed having a press conference after a rate decision was supposed to be to give people more information. But what happened yesterday, all it did was increase confusion and volatility yesterday. We would all have been better off yesterday if on the way to the press conference, Powell had pretended to pull a hammy and had to cancel the press conference. We'd be in a better place today. But look, they're trying their best, I guess.
Yeah, this whole idea of trying to get the market to make the adjustment before they make the adjustment, it's kind of nonsense, right? You saw that through the first half of 24, the Fed hadn't done anything except for chinwag about the fact that they were going to be reducing rates at some time in 2024. So everyone gets all excited and the market creates a lot of liquidity, whether that be through interest rates coming down in the market or whether that be through equity prices going up and making the haves much wealthier. The problem with that is the underlying kind of class of society that isn't invested in the markets, isn't participating in this trying to read the Fed's,
Right.
their comments, is they're really disadvantaged, because then the Fed's like, well, wait a second, you guys took it too far. And all of a sudden, like, people are scratching their heads at where to go from here.
Yeah, the biggest beneficiary of the Fed communication policy shouldn't be day traders.
or the Fed's social media, right? Like, how many Fed presidents now have their own PR kind of teams behind them so that they can go out and communicate what they're trying to get across in these meetings? It really makes no sense. These are supposed to be elected officials who are doing the best for their constituents, not trying to get on CNBC every other day.
Appointed officials, probably, right?
Oh yeah, sorry.
But that's okay. No, I look, I'm looking forward to a Kashkari TikTok dance. Hopefully he does it before they ban TikTok.
Our fifth theme for 2025 is around mergers, acquisitions, and activism. Adam, how are companies going to use these types of strategic plays to navigate uncertainty next year?
Look, I think there's a couple dynamics going on. I mean, obviously we have a change in administration, and there's a view that Republicans are going to be more friendly towards deals than the Democrats have been. But I also think a lot of companies have been sort of shy about doing M&A. And now I think they'll feel more emboldened, one, because they'll feel like there's a higher probability that a deal can get done. And also with more stability in rates, now that the rates we at least know that they've probably peaked for this cycle, and they've come down 100 basis points, at least the Fed funds rate. It gives you more of an ability to model out how to finance a deal than when rates were just on the way up. And the beauty of when rates come down is you can always refinance at lower rates if they come down. So it gives people a lot more, dry powder. And then you've also got private equity firms, which have been sitting on portfolio companies that they wish they could have exited from a couple of years ago. And now 2025 might be the opportunity. And they're not going to want to miss it.
Austin, what are your thoughts?
I think we're at a really unique time, mainly because we're coming out of a period with extremely low Fed policy rates, which in general you would think would be supportive of M&A, but in reality what it seemed it did, especially in the current administration, is it just loaded the coffers of private equity firms who now have tens of billions of dollars to go out there and basically pay up for assets. I think going forward, as the Fed starts reining in liquidity in the market, we're likely to see more mergers happen rather than straight out acquisitions for cash, PE funds taking them private, because there will be less cash just sloshing around in the system, which will likely create better valuations and allow more strategic transactions taking place. This is probably good for the investment banks. This is probably good for some of the larger companies who have the ability to consolidate more in their space. And then smaller companies that can't get the margins of larger companies could get bought out at a premium. So it's probably a general positive, but there are a lot of moving parts here because we do have kind of money coming out of the system and that will really impact what prices some of these transactions take place at.
Our sixth theme for 2025 is around investor mindset. We're fortunate we get to work with a lot of younger advisors at Opal Capital, and we've had the opportunity to educate folks on Alan Greenspan's irrational exuberance comments of the 1990s. Today, as we're recording this at the end of 2024, the term seems to fit. Adam, what do investors need to be thinking about as it relates to the investor mindset and its impact on the markets?
Look, I think there's something about the way human brains are wired where we tend to think that tomorrow is going to be just like today, and so we tend to extrapolate what's happening today into the future. And maybe that's not an unreasonable way to project when you don't have additional information. But the reality is, when you're looking at the stock market and everything's great, and there's not a cloud in the sky, and everything seems perfect, you should be somewhat terrified because it's not going to last. And it's interesting because talking about this today, given that yesterday after the Fed conference call, when we saw this spike in the VIX, which is volatility, which you can just think of as the cost to insure against a drop in the S&P 500. If you want to put it very simplistically, that cost of insurance rose significantly from a very low level. And it happened within the matter of an hour. And that was just a quick reminder to everyone that when things go bad, it can happen quickly. There's not a cloud in the sky, and that storm comes fast. You can think about in August of 2011, the U.S. debt got downgraded. There was a European sovereign debt crisis, and the S&P 500, and I'm ballparking the numbers, but it went down something like 20% in 9 trading days. That's fast. So when there's not a cloud in the sky, don't think that tomorrow there won't be.
Yeah, what's the saying? The markets take the stairs up and the escalator down. Austin, what are your thoughts?
Yeah, I think it's the stairs up and the elevator down.
Even faster.
I listen. I think that in times like this, people need to realize that asset prices do not typically just go straight up to the right. If they did, there would be no need for risk-adjusted returns because there would be no risk and just returns. And so I think people need to reevaluate the fact that there is risk in the market, and the risk is often the greatest when everyone thinks that risk doesn't exist. And so it just reminds us to take a step back and think about hedging portfolios. When you think about hedging, there are actually a lot of really cheap hedges out there right now, which can become more expensive really quickly when people start to realize that risk does exist again. So take the opportunity where no one else is paying attention to put some hedges on that are really cheap. You'll be happy you did at some point.
Our seventh theme for 2025 is pay attention to the international markets. Adam, could the international markets potentially outperform U.S. markets next year?
I knew this was going to be our seventh theme because I've wanted to mention international since the very first theme. Because here's an interesting fact that you might not know about international companies, and that they're not part of the Magnificent Seven. Isn't that wild? They're not. And look, it's hard to make the prediction that the international markets will outperform the U.S. in 2025. That's tricky. I will say this: I think some of them will. The key with international markets is that's the rest of the world. You want to actively choose which markets to go into. They won't all. I'm pretty confident that not all of them will outperform the U.S., but a lot of them will. So it'd be nice to be in those ones, and it's an element of diversification. U.S. or non-U.S. markets, most of them, from a valuation perspective, are cheaper. Significantly cheaper in many cases than buying the U.S. market. So if your portfolio is very U.S. centric or completely U.S. centric, heading into 2025 is a great time to think about adding a little bit of international exposure for diversification, and also potentially to help your returns in 2025.
Yeah, Austin, what are your thoughts on the international markets for next year?
Yeah, I think on the theme of rhyming with the late 90s, the last time we saw investors kind of throw out the rest of the world and only focus on the US was in the late 90s. And the decade that followed was a boon for international investors and was a really tough one for US investors. So just keep that in mind as you're allocating between countries. We do have a lot of clients that call up and say, hey, the US is the only place to be. That's where we want to invest. We think from a forward-looking perspective, it does make sense to have some international exposure. The growth may not be as great, but the valuations are far better internationally. In many cases, you can get some valuations that are about as low as they've been in the last 20 or 30 years. We don't think that investors should just throw them all out. We think that there are pockets where one can invest and make really great risk-adjusted returns in international markets.
And to be clear, if you live in the U.S., the vast majority of your investments should be in U.S. companies, in U.S. dollars, et cetera. But that doesn't mean you shouldn't have an allocation to international markets to add that diversification and to help in times where international markets outperform the U.S. And again, like as Austin suggested, there are definitely times where that is the case, and valuations are very different country to country.
That's a great segue into our 8th theme for next year, and that is the reemergence of active management. As we look to next year, there are obviously headwinds and tailwinds. Austin, as you look at the U.S. equity markets, what are the potential tailwinds investors should be paying attention to?
Yeah, there are a number of kind of tailwinds that people have been really focused on over the last month and a half or so. The biggest is likely deregulation. There's a lot of positive sentiment around the fact that less regulation is going to free up the underlying economy. There's also been a lot of, I would say, positive sentiment about just innovation in tech, making the economy more efficient going forward. We think that's a trend that could continue into 2025. Albeit it might play out differently than it did in 2024. A final trend that, is kind of a toss-up after the most recent Fed meeting, but there is expected to be some Fed policy easing in 25. It might not be as aggressive as people originally thought it was going to be, but that should be supportive of valuations, as it does mean there will be more liquidity in the system. And then finally, the expectation that taxes don't increase and that energy prices come down. Those are two significant components into the profitability of corporations in the U.S. and also the amount that U.S. citizens have to spend. It could be a big tailwind for the U.S. economy.
Adam, what are the headwinds investors need to pay attention to here domestically?
Yeah, there are some very serious headwinds that people need to be mindful of. I mean, first, at the highest level, the S&P 500 is trading at a very robust valuation, and at some point, the market could decide that that's just a little too expensive, and we could see that valuation come down. And part of that could be another potential headwind is we could see some significant, meaningful tariffs being used either as a negotiation tactic or actually coming and being implemented in as soon as whatever January 20th, which could have significant impacts on specific companies and could also lead to increased volatility and concerns about valuation. There could be labor issues. If labor, if people are getting, there's an immigration issue. We don't need to get into the nitty gritty, but one of the ways the population growth grows is through immigration, much of which is legal, some of which is illegal. But either way, the two components of growth are immigration and productivity gains. And if you don't have immigration, you're taking away one of those levers of growth. And finally, I'd mentioned the U.S. debt and the federal deficit. We're as we seem to always be. There's a debt ceiling issue. There's headlines that maybe we should get rid of the debt ceiling. We're talking about the U.S. Government's interest expense. We used to talk about it in the hundreds of billions a year. Now we're talking about it in the trillions a year. And at some point, that just becomes a burden that the market says, hey, we're not comfortable with the amount of interest expense you're paying as a country, and all bets are off. And that could be a very serious issue.
Let's shift overseas. Austin, as you look to 2025, what are the tailwinds for international investors?
Yeah, I think the biggest tailwind is potentially valuations. Valuations internationally are extremely cheap compared to the U.S. And the combination that would really turn that into a tailwind would be if we get an inflection on growth internationally. Growth has been relatively anemic in many developed international markets. If that was to change for one reason or another, you could see valuations start to perk up and see decent returns overseas. The main point that could drive all this is just easing monetary policy. The U.S. has been easing pretty aggressively for some time. We've seen that the requirement to tighten in certain international markets. We think some of those governments could start easing, which could kind of create a source of cash in those markets, which could contribute to growth. And that might be the driver that frees up valuations and frees up growth in many of these markets.
And Adam, what do you see as the headwinds for international investors next year?
Yeah, there are some significant potential headwinds. Obviously over the last couple of years, we've seen some geopolitical events that we didn't anticipate. Wars and conflicts in Eastern Europe and the Middle East. If there's more unrest or continued unrest, that's never a good thing. The before mentioned tariff issue is obviously has an impact on the countries that are on the other side of those tariffs, and sort of alongside that, there are currency issues whereby as the U.S. dollar strengthens and foreign currencies devalue, you have to remember that a lot of foreign countries have a lot of their government debt is denominated in U.S. dollars to entice U.S. investors to participate in that government debt. So if their currency weakens, their ability to pay off that debt becomes far more expensive for them, and that can be an issue. A lot of countries have energy costs are a big part of their expense. So if energy prices were to spike for any reason, be it geopolitical, be it supply issues, etc., that could have an impact. And then, as always, there's growth. In some of these countries are used to growing far more than what we think of in the U.S. But if a country's used to growing their GDP at 5+% and it comes in at 3 or 4%, we might think that would be great here, but there it's under what it had been, and it's a cause for concern.
Excellent. Gentlemen, this is by far the longest podcast we've ever produced. I hope everybody enjoyed our 8 major themes for 2025. Download your copy of the themes by visiting opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.